in this session. My name is Adrienne Cheasty, and I'm at UPEP, the European Studies Political Economy Project at St. Antony's College, Oxford. And I'm very pleased to be chairing this session, which is called Financing for COVID and Climate Action, ? The best use of the IMF SDR allocation. And this is part of our Monday seminar series on the political economy of climate change. So join not only tonight's seminar, but also seminars in future weeks, please. I'd like to thank not only our distinguished panelists, but also all the audience who are interrupting their bank holiday for this seemingly very esoteric subject, because they know how important it is. Just before I introduce the panelists, let me spend a couple of minutes explaining why it's a logical component for a seminar series on European issues. As I'm speaking, foreign ministers from the G7 are meeting in London, hosted by Dominic Raab, to prepare for the G7 Leaders Summit in Cornwall in June. The fact that the UK is president of the G7 at the moment gives the government a valuable opportunity to align the global agenda in terms of the UK's own priorities. And the two priorities the UK has identified for the presidency are, first, to unite leading democracies to help the world fight and build back better from COVID. And secondly, to create a greener, more prosperous future, meaning climate change is prioritized. And these priorities are shared by the EU, which is attending the G7 as an observer, and frankly, it's a constructive opportunity for cross-border cooperation in the wake of Brexit. While obviously the G7 discussion will be about strategy, much of it will have to be about how to pay for COVID and for climate change, not only among the G7 countries themselves, but also the developing countries, which, as we can see more and more from day to day, are urgently in need of multilateral support. And the problem is, of course, that the rich countries are feeling acutely budget constrained. The UK's foreign aid budget has been cut from 0.7% of GNI to 0.5%, a drop of 1/3 at a very inopportune time for a cutback in the UK's soft power, particularly if one concern is the UK is just entering into the presidency of COP26, the global climate negotiations round, which will be held in Glasgow in November. And so it's important that the UK be able to leverage the voices of as many countries as possible. This is where SDRs come in. SDRs could be immensely helpful in addressing this issue of budget constraints and supporting a global financing effort. I'm happy to leave it to my expert panelists to explain how SDRs work. But in short, the proposed new SDR allocation would contribute $650 billion to the global economy, which would be shared proportionately across the world by economic size of the countries. And it will be issued with the goal of fighting the pandemic and helping global recovery. The UK is strongly behind this proposal. The Chancellor says it means no country will be left behind. So the question for today's discussion is how best to use this timely financial windfall. In other words, what do we think Dominic Raab should be proposing to foreign ministers this week? Given the importance of the topic, I'm especially pleased that we have such an eminent panel to talk us through the issues. I'm going to turn first to Mark Plant, who has been one of the foremost advocates for the new IMF SDR allocation. Currently, Mark is co-director of development finance at the Center of Global Development and the chief operating officer of CGD Europe. Prior to that, Mark had a long distinguished career at the IMF, culminating as director of human resources, but also with a range of senior positions where he designed policies for debt relief and conducted relations with African countries. And way back, Mark held senior positions with the US government and taught economics at UCLA. So Mark is going to give us an overview of the SDR allocation and the issues it raises for G7 policymakers. Now, in the interest of getting into a discussion, let me introduce our other distinguished speakers at the same time so we can have an unbroken discussion from then on. After Mark has presented the SDR allocation and the issues, we'll turn to Mark Henstridge and Stevan Lee to give us the UK-based perspective on this. Both Mark and Stevan are from Oxford Policy Management. This was a group founded in Oxford University 4 decades ago. Now it's separate with offices globally, and it advocates policy reforms for developing countries. Mark Henstridge is OPM's Chief Executive Officer, and he joined OPM as Chief Economist in 2012. He's also a research associate at the Oxford Centre for the Analysis of Resource-Rich Economies, previously acting executive director for the International Growth Centre, which was a DFID-funded initiative at Oxford and LSE. And earlier he worked in BP, at the IMF, and in the Ugandan government. And he has a DPhil from Oxford. And last but not least, Stevan is OPM's acting chief economist. He was previously head of economic research at the UK's Department for International Development and a senior economist at DFID and at the World Bank. He has extensive country advisor experience, including 9 years of residency in East Africa and also in the Middle East. And he has a PhD from Nottingham. I've kind of messed this up because I think Stevan's going to speak second and Mark Henstridge is going to close with the more visionary proposals for what the UK should be doing. Now, on administration, we've asked Mark Plant and the OPM team both to speak for about 20 minutes. That leaves time for a discussion within the panel on each other's proposals and with the audience. We welcome audience participation in the discussion, so please submit questions to the panel. The way we ask you to do it is to submit questions to the Q&A box, which I, as the chair, will be monitoring. And then I'll direct your questions to the panel. But if we can, we'll get the person who put the question in the Q&A box to repeat it on the screen. So audience members might wish to signal when they put their question in the Q&A box, whether they would prefer to repeat the question on the screen or not, or just to have me read it. Use the Q&A box, don't use the chat box, because we use the chat box for administrative messages to each other. And also, I believe Julie will put the bios of the speakers in the chat box so that you have them there. Okay, enough from me. Let me hand over to Mark Plant for this very interesting and elucidating presentation. Thank you, Mark.
Thank you, Adrienne, and it's a pleasure to be virtually with the Oxford community today. I trust you can all see my screen.
Yes.
Good. Good, thank you. So I want to talk a bit today about what an SDR is and how we might unleash the power of SDRs. As Adrienne says, there's great hope placed by the international community in the power of SDRs to address some of the financing problems for the COVID crisis and the recovery, the sustainable recovery after the COVID crisis. But special drawing rights are a peculiar thing. They're a pretty obscure part of the international financial architecture that not many people understand. They've come very much to the forefront, and lots of people are putting proposals forward for them. And it really is important that you understand how they work in order to see if these proposals really make sense. So I'm going to answer 5 questions in the course of the discussion. What are SDRs and how do they work? Why do we need more SDRs? What will the new SDR allocation yield? How can SDRs be recycled or reallocated? Words that will make more sense when you get to by the time we get to that slide. And finally, what should SDRs be used for? First, what are SDRs and how do they work? An SDR, a special drawing right, is a reserve asset of a central bank that's issued by the IMF. It belongs not to the IMF, but to each central bank in the world. So each central bank has its allocation of SDRs. And an SDR is a claim on any of the IMF's reserve currencies, convertible on demand. So if a country needs convertible currency, if it needs dollars or it needs euros or pound sterling, it can come to the IMF and say, I would like to exchange my SDRs for convertible currency. And the IMF will arrange that exchange with another of its member countries. An SDR is worth now about $1.43. Its value is determined as a basket of 5 currencies. And currently there are $318 billion worth of SDRs in existence, allocated among the 190 members of the International Monetary Fund. The last time a new allocation was done was in 2009 as a response to the global financial crisis. But the SDRs are in fact a very small part of global reserves. Global reserves are roughly $14.5 trillion, so 318 billion is a few percent. These SDRs are allocated proportionally, as Adrienne said, according to IMF size or IMF quotas. Members of the IMF have a certain share of the institution. They contribute to the financial capital of the institution, and they receive SDRs in proportion to that share that is contributed. And the shares are based roughly on importance of the countries in economic activity in the world. So why do we need more SDRs? We have 318 billion of them. Why should we have more? Well, the COVID-19 pandemic abruptly, as we all know, reduced economic activity across the world. It restricted trade in almost every country and squeezed budgets. The policy response is well known by all of us. It was to increase liquidity in the system. The Bank of England, the European Central Bank, the Federal Reserve, all essentially printed money. They used their monetary policy tools to flood the system with liquidity so economic activity would not stop. And it allowed governments also to increase government expenditure. They increased their budgets, they spent well beyond the revenues, deficit spending, if you will, financed by bonds. And this was, again, an attempt to keep economic activity alive, to keep economic actors well-fed, to keep people well-fed. But this range of economic tools was not as available to many low-income countries and middle-income countries, so-called LMICs, which were also confronted with a serious loss of foreign reserves, mostly due to declining export sales. Many middle-income countries and low-income countries are heavily dependent on exports for their revenue. With the drying up of international trade, they saw their revenues dry up, they saw their foreign exchange disappear. And therefore, they found themselves having to reduce expenditure on necessary items from abroad. They became foreign exchange constrained. Now, normally when countries become foreign exchange constrained, they do it one by one because of a particular crisis in one part of the world or another. And aid donors can step in. Either the IMF steps in with a loan or UK, European donors will step in to help them out. But we're confronting a situation where all countries are in the same position. UK and European aid budgets are constrained, so their ability to intervene and help these countries out is limited. And as Adrienne mentioned, in fact, what you've seen is many countries restrict their foreign aid in the face of the COVID crisis rather than expand it, when low and middle income countries are asking for an expansion. So the SDRs provide these countries with some more flexible reserves, so they can continue to do imports, make debt payments, and can continue to grow their economies as they see fit. It gives them the needed reserve flexibility that was taken away by the COVID-induced economic crisis. And it can also give them more budgetary room as well, to the extent that countries cut off, say, important projects that had large import components. Say they were building a bridge and needed to import steel and didn't have the foreign exchange to do this. Having the SDRs could potentially give them that needed foreign exchange so they can restart their projects. So basically, it's a way of increasing global liquidity, much as the Bank of England did for the UK, the ECB did for the European Union, and the Federal Reserve did for the United States. It's a global increase in liquidity. So what will we get out of this SDR allocation? There was an agreement reached to do a new allocation of the equivalent of $650 billion worth of SDRs. Where did this number come from? Well, it turns out that it was bound by United States legislation. So in order to allocate SDRs at the IMF, you have to get 85% of the membership agreeing to do so. United States holds a 17% roughly holds 70% of the votes at the IMF. So the United States had to be willing to go along with this SDR allocation. for the United States government to signal its assent, it can do so by only informing the United States Congress if it's under 650 billion. If it's more than 650 billion, it requires the active assent of the United States Congress. Now, the reason the SDR allocation didn't take place before now is essentially the Trump administration blocked it. When the Biden administration came in, they signaled they're willing to go along with an SDR allocation, but they were unwilling to enter into a fight with Congress, especially with the slim majorities they had. So they said, let's limit the SDR allocation to the amount we can do without getting Congress's permission. We'll inform Congress that we're going to do this. And $650 billion was that amount. So that's where it came from. The allocation requires approval by the IMF Executive Board. That's due to take place in June. And then by a vote of the IMF membership, country by country, that will take a couple months. So in the end, the allocation expected to take place in August. As I mentioned earlier, it's divided by the size of the IMF quota. So the UK, of the $650 billion worth of SDRs to go out, the UK will receive just over 4%, about $27.5 billion worth, or 20 billion pounds sterling worth. And the European Union would receive about 100, all the European Union countries together would receive about $170.4 billion. And you can see on the chart, on the left-hand side of the screen, the allocation region by region. Now you look at this allocation, and I should have probably done one by rich countries and poor countries. And what you'll see is most of the allocation goes to rich countries, to the very countries that don't need the SDRs. What we said is we wanted these SDRs to go to low and middle income countries. I think about maybe 10% goes to African countries. I can't quite remember the percentage for middle income countries, but you have a very small amount relative to the total amount of the 650 billion going to these countries. You have the United States getting a large amount, about 18%, and the UK and the rich countries getting substantial amounts. So this has raised the question in people's minds, well, it's good to do this, but is there can't we somehow reallocate these SDRs? The UK doesn't need their SDRs. They have plenty of reserves. The United States doesn't need their SDRs. They have plenty of reserve. European countries have plenty of SDRs. Is there some way rich countries can give their SDRs away to the poor countries? This is called reallocation or recycling. The IMF prefers the term recycling for reasons I'm not quite sure, actually. The G20 has asked, in the context of their latest meeting in April, that the IMF and the international community find innovative ways to use SDRs, that is to recycle them or reallocate them, but maintain their quality as a reserve asset. So they still have to comfort countries' reserves position. The SDRs are governed by local legislation because, as I said before, each central bank owns its own SDRs, and by IMF rules and accountings. And this makes it rather difficult to have a universally agreed way of reallocating SDRs. Let me give you two examples. In France, the SDRs belong to the central bank, but for them to be reallocated to another government requires an act of the French Parliament, would have to go through the same budgetary processes that any budget allocation would take place. Another example is in Germany, where actually the SDRs belong to the Bundesbank. The government and the Bundesbank are completely separate entities. The government can in no way tell the Bundesbank what it should do with the SDRs. And so the government has no control, if you will, over how those SDRs are used. They're completely within the control of the central bank. This sort of idiosyncratic local governance of the SDRs is repeated across 190 members of the IMF. And so it's very difficult to say, we're going to just pick up a bunch of SDRs and move them over, because every country owns these SDRs and every country will have its own strictures as to how it's used. The IMF also has its own rules and accounting about how SDRs are governed, which we can get into in the questions if you're interested. The easiest way to use these SDRs is to keep them within the IMF. This has been done before. Countries have given their SDRs to the IMF's low-income support facility called the Poverty Reduction and Growth Trust for on-lending to poor countries. This would make sense. France or Germany or the UK would give their SDRs to the IMF's poverty fund, and the IMF would decide where money was needed and lend it out. That's a fairly straightforward way to do it. Again, it's been done by the UK, by the Netherlands and other governments in the past, and it's a well-known path. One difficulty with that path is it doesn't allow middle-income countries to access these SDRs. So people have asked, how is it that middle-income countries could get some of the reallocated SDRs from the rich countries? People are still thinking about that. It's a difficult problem. It's hard to take SDRs outside the IMF for two reasons. First of all, there are only certain institutions in the world that are allowed to hold SDRs. The World Bank is one. The Latin American Reserve Fund is another. There are about a half a dozen around the world. These countries could receive SDRs and deal with them, but there's a question about whether, again, whether individual countries who own the SDRs can make that kind of a transfer. If you wanted to use the SDRs outside the number of limited holders of SDRs, in fact, what you have to do, you'd have to convert them into hard currency and then give them to another fund. So if, for example, France would like to give its SDRs to a fund to purchase vaccines in Burkina Faso, France would have to convert its SDRs into hard currency and give those monies to the fund to fund the vaccines. And that begs the question is, why not just use reserves in the first place? Why bother using SDRs? If you're going to give some of your reserves away, if you're going to convert some of your reserves, you should just give the reserves that you have in place. So there are complicated discussions going on. Mark and Stevan will talk about some of the difficulties of doing this in the UK context, and you'll get a good idea of the fact that in principle, reallocation is an easy thing to do, but in practice, it turns out to be much more difficult. So the other debate that's going on is, what should SDRs be used for? The G20 has called for their use in a transparent and accountable way. They want to be sure that the SDRs that are being given out are not used for lining illicit dictators' Swiss bank accounts. They want to be sure that they're not used for paying debts or using certain kinds of debts, buying military equipment. They want to see rightfully how the SDRs are being used. In fact, no one has any control over the initial allocation that countries will get in August. Those SDRs belong to the country. They can convert them to currency and use that currency any way they want. And there's nothing anyone can do about it. They can ask them about it. They can ask, what did you do about it? But in fact, money is fungible. So it's going to be a bit difficult to see exactly where the extra expenditure that was enabled by the SDRs will be done. For recycled SDRs, for those that are going to be gifts from rich countries to poor countries, there are possible controls. That's another reason people have been looking to the IMF as the controlling instrument, that the IMF has very clear standards about how it gives money and transparent standards about how it's used. So another reason that people have said to stay within the IMF, but other people are looking at other possibilities. One thing that everyone's emphasized is that time is of the essence. This crisis is on us, it's still not over, and the more we diddle about how we're going to do this, the more the crisis risks getting out of control. So people see a new allocation of funds, they see a budget constraint relaxed, and they say, what should we do with it? And there are lots of ideas out there. So, for example, vaccine funds. Lots of low and middle income countries are having trouble purchasing vaccines. They have a shortage of foreign exchange. They'd like to purchase vaccines. Why not give them the wherewithal through the SDR allocations to purchase vaccines? And in fact, you could assure transparency and accountability by donating, say, to COVAX on behalf of countries, and therefore you'd know exactly where the money was going. People have argued that we should top up countries' financing for climate financing, looking from the short term to the medium term, or for financing for other kinds of SDGs. Again, people see the relaxation of a budget constraint. They see some money floating out there. There are lots of ways to do it. And there are long, complicated discussions taking place within the G7, within G20, within the IMF as to how this money should be spent. There are lots of good ways to spend it. I think we come back to the principle that it should be done in a transparent and accountable way, and really rather quickly. So we should find ways of doing it that are fairly rapid, because if we wait, the problem gets even more out of control. Let me stop there. Thank you, Adrienne. And thank you for your patience.
Thank you very much, Mark. As usual, for me at least, as a former IMF person, but I hope for the whole audience, this was very clear and it put things in context very well. But I think one reason for this seminar is that we all care about how these get used. And so I'm happy to turn to OPM, to Stevan and Mark, to discuss the perspective that one important country, the UK, may have on the use of these SDRs. So let me turn over to Stevan first and then to Mark to address, to tell us the answer, please.
Thank you very much. Tell me if you can't hear me, but it should be working, I hope. So thanks very much to Mark Plant for sort of laying out the facts about SDRs. I'm going to now talk about the problem-centered part of the presentations, why we need to do something, what's happened since January 2020 that makes us think we need to act now. That looks about right. Okay, so the first slide. Oh. The issue is whether the slides are going to move a bit. This is the first slide I really want to talk to. So this is about the size of the impact of COVID on some low and middle income countries, the sort of countries that Mark Plant was just telling us about. So COVID isn't over, but this is the net impact on GDP after 2 years. And it's pretty big. You can see it's 6 to 9% reductions in GDP across Africa, quite homogeneous, significantly worse in South Asia. Now, the ability of governments to act is much more variable. So the fiscal response is, that's the increases in public expenditure to respond to the crisis. That's highly dependent on the income level and the creditworthiness of different countries. So we know that high income countries have undertaken trillions of dollars of stimulus between them. In the graph, in the middle here, are some larger middle income countries which were also financially constrained before COVID. They still manage a large fiscal stimulus in this period. That's the blue bars, the light blue bars. See, South Africa has pretty large fiscal stimulus there. On the left are a group of lower income, highly financially constrained countries. And if you focus on the blue bars again, you can see that they manage, what they manage is in terms of fiscal stimulus is between small negative and small positive. And you can also see how they cut back on investment, which is the gray bars. So the gray bars are in the negative for these countries, all of them. The group on the right is less financially constrained, and we're going to skip those for now. So the size of that fiscal stimulus really matters. This is a simulation of Uganda that appears in our Oxford paper, Adam Henstridge and Lee 2020. It's a modified IMF DIG model that's sort of endogenizing debt, investment, and growth. And it's showing paths of consumption under different international financing scenarios. Consumption, not output, so not GDP, part of GDP. The green line then is the path of consumption without international finance. So a very deep initial drop and a recovery over several years, not really getting back to the previous level of consumption for a very long time. The blue line shows that path of consumption with international finance for a fiscal stimulus sustained 2020 through to 2023. Actually, this is based on Uganda accessing its share of a putative 80 billion IDA replenishment in 2021. That's a replenishment that's not happened yet, but that's the kind of level of financing they would need to get to the blue. The pink line, or if it's purple maybe, that's what might happen if the crisis is a spur to economic reforms. So the point is, if the external finance dries up and the reduction in the reduction in consumption investment is even greater than the reduction in output. So, 6 to 9% of GDP reduction in output, even larger combined reduction in investment and consumption. It's not just about the public sector. An externally financed fiscal stimulus can reverse that effect, depending how large it is the size of the reversal. So without the stimulus, there's going to be deep cuts to public and private investment and consumption. That's going to worsen scarring and slow the economic recovery, slow it right down in these sorts of countries. This modeling was from early 2020. The forecasts change over time, but Uganda is pretty close to the blue path at the moment, but it won't stay on that blue path unless international finance continues to be channeled to Uganda. And the trouble is the actors like IDA and the PRGT, that's bits of the World Bank and the IMF that financed Uganda in the apex of the crisis in 2020, they extended themselves in 2020 and will have to cut back international financing in 2021 unless they are topped up. So the idea is, to do with how to do with that. So this is going back to the size of fiscal stimulus in that 2019 to 21 period again, and showing that how important the official financing is in supporting fiscal policy in different countries. So the yellow bars are the accelerated finance from the IMF, the World Bank, and the regional development banks, and a few others in 2020. Not the total, but the financing that they did above the normal level, simplifying. And this was big, well over $20 billion for the countries in this graph. On the left-hand side, you can see the low-income, highly financially constrained countries. You can see that the yellow bars, which are the accelerated finance, are large compared to the blue bars, which are the fiscal stimulus. The group in the middle are the larger middle-income countries, which had fiscal imbalances before COVID. The large fiscal stimulus in 2020, that's the blue bars, and the damage to GDP makes those fiscal imbalances they had much worse than they were after COVID. The yellow bars, with the extra help they received in 2020, they are quite small compared to the blue bars. So, these countries are hard to help. They're larger, they're not so poor. Certainly South Africa and India, harder to help. So, South Africa, it was a weak economy already in 2019. Unsustainable public finances before COVID. That's all made worse by COVID. So radical reform is now even more urgent in South Africa. It was needed already, it's now needed more. Ramaphosa says he understands this. It's going to be difficult politically to do that in South Africa. It's a problem which is hard for the rest of the world to solve. SDRs help a bit, but the problem is really bigger than that. India is a different situation from South Africa, smaller problems before the crisis, but India was running very large fiscal deficits during the high growth that it was experiencing before the crisis. That turns into a pretty gigantic 12.5% of GDP deficit in 2020, pushes debt indicators into dangerous territory because they were already sailing quite close to the limits on debt in the good times. So COVID is far from over in that country, but clearly it's going to be difficult to avoid a sluggish and drawn out poverty causing recovery in India, because it's going to be hard for the Indian government to act during that recovery period. Again, it's going to be hard for the rest of the world to solve that problem. The SDRs help. They're not big enough to solve the whole problem in a country like India. However, moving back to the group on the left, which is the lower income, financially constrained countries, they were a bit like India before 2020, and they were growing pretty fast, but they were also running high deficits and selling a bit close to debt distress, even when their economies are doing pretty well. Short on buffers is an IMF way of talking about it. So if we think about Kenya, they've been talking about fiscal consolidation there for a number of years. Certainly in 2018, they were talking about fiscal consolidation. That's reducing the public, the fiscal deficit. to avoid a higher risk of debt distress. They were talking about it in 2018 and before that, but not really done anything about it. There's still a sort of 7 to 8% public deficit there, not very much extra during 2020 because they're at the limits and quite enabled by the international finance to do that. It's still a large deficit in Kenya, but now Kenya is facing much tougher fiscal consolidation and expenditure cuts to avoid debt distress, and it doesn't have too many options. It really matters just how soft lending from international institutions and governments it's going to be in the future. More non-concessional external financing isn't going to be absorbed by the government in Kenya because it isn't sustainable, and it's going to push Kenya's debt indicators into something that looks like serious debt distress. Debt to GDP is basically too high in Kenya. So the government of Kenya only really wants to take on high concessional debt. What it really wants is grants and debt cancellation. And in the case of Kenya, the rest of the world can help. But SDRs, the SDR allocation, or even IMF loans, which are not too concessional, might not be enough to help Kenya. Ethiopia, just one more example, that needs highly concessional financing even more because its large deficits and, well, its fiscal position, its debt position was already becoming unstable in 2018-19. Maybe not such large deficits actually, but its debt to exports and its debt to revenue ratios were putting it into a high risk of debt distress in 2018, 2019, definitely. Ethiopia needed at that point before COVID to transition away from the growth pattern it's been enjoying, very fast growth, but based on externally debt financed public investment. That was going to be difficult. COVID just makes it much more difficult. It makes all the imbalances worse. So it's really only on a very optimistic GDP forecast and estimate and a promise of rapid fiscal consolidation that Ethiopia looks solvent going forward. The rest of the world can really help that recovery period for Ethiopia, but SDRs by themselves and even some normal IMF loans might not be enough to help Ethiopia enough. So that's the problem we need to solve. Obviously, the rich countries have their own constraints. Mark is going to do a somewhat UK-centric presentation now. I'm not quite sure if I'm supposed to be keeping the screen or Mark's going to share his screen, or maybe I'm supposed to be moving through our slides for you, Mark.
You're going to keep the screen, please, Steven, and move forward. Thank you. So this is the outline. Steven's highlighted problems. I'm going to try and pick up some of the characteristics of the SDR that Mark highlighted earlier, and see if there's a way of thinking innovatively about bringing reallocation of SDRs or redistribution, or whichever the right word is for the IMF, to bear on the problems that Steven's outlined. Essentially, the countries which can do the least are among the hardest hit. Rich countries could do, quote, whatever it takes, and did, to the tune of trillions of dollars, and poorer countries couldn't do that. They had weaker balance of payments in the pandemic, and several of them, as Steven has detailed, have debt problems. And as Mark has highlighted, new SDRs are a solution. Even if low-income countries only get 3.2% of the total quotas, which out of $650 billion worth of new SDRs is about $21 billion, it's still of real value, even though it sounds like a small percentage. It's a significant addition to international reserves for low-income countries. The problem of indebtedness for low-income countries, however, means that taking on yet more SDRs, even if there's zero interest when the IMF's PRGT, the concessional lending bit of the IMF, steps up, has a reallocation of SDRs from richer countries to it, it is still debt, and that's a bit of a problem. And what Steven and I have done is look around and see, well, where else has the finance come from? And during 2020, the finance for low-income countries came from the PRGT at the IMF, a significant increase in support, but it also came from the International Development Association, IDA, at the World Bank. And if you look at the scale of the last replenishment of IDA, you see that it is of the order of $80 billion. So almost 4 times the scale of the distribution of SDRs that will go with the new issue in August to low-income countries. Now, if you tick on one slide, Stevan, we can illustrate the difference between the SDR issue, the share of the SDR allocation as a percent of GDP, and we used a figure of 600 billion in the blue box for each of the countries that Steven's talked about, and the share of an IDA replenishment in the last replenishment of IDA 19, also as a share of GDP for all these countries. And the point that we're making is that the distribution of the last IDA replenishment was significantly more valuable to low-income countries than their share in a new issue of SDRs would be, good though that is. And 80 billion is a small share of the total 650 billion expected in the new issue of SDRs. If you look across the G7 group of countries, and Mark gave the illustrative example for the EU, you find that there's really a very similar share. They will receive roughly $281 billion worth of new SDRs, but it is 80 billion is only just under 30% of the total that will be received by the G7 countries. Now, Mark highlighted that there's a lot of complexity country by country in making a donation of SDRs. And while it does need detailed work, and that the note that Mark and David Andrews, another IMF colleague, have written from CGD sets out the specifics for the UK, it is entirely feasible. And as Mark said, actually what you could do is fund a donation out of reserves as a result of receiving SDRs on top of existing reserves. So we think that there's a strong case for a new allocation of SDRs, which will go disproportionately to rich countries, being used to fund an early replenishment of the International Development Association. And this has a number of important advantages for poorer countries. One is scale, as this slide illustrates. 80 billion is almost 4 times as big as the value of SDRs, which would go to low-income countries' reserves from the new issue. Another is speed. IDA is a well-established global institution targeted to low-income countries. It has criteria for lending. It has the transparency and accountability that the G20 has asked for. And the criteria for lending by IDA, or for IDA to make grants, so it can sidestep the problem of indebtedness for the more vulnerable low-income countries, are reasonably well aligned with the challenges those countries are facing in the wake of the pandemic. The other is that so those are the points that show that there's an early replenishment of IDA has important advantages for poorer countries. Now, what the solution boils down to for the UK, as I said, is that if the UK cannot literally donate SDRs, and that's a function of the way in which SDRs are treated in UK legislation, of the way that the Treasury manages reserves in the UK, it is the case that the UK will receive some £20 billion or $27.5 billion worth of new SDRs. It's a very significant increase for the UK's reserves, and the contribution to IDA, if the G7 clubbed together and put 80 billion into IDA, would be just under 30% of that extra addition of SDRs. It's about £5.6 billion. So if you could move forward one slide, please, Stevan. What this does is try and set out some of the magnitudes as a walkthrough. And it starts with what in normal times is the scale of lending from the PRGT. This is the IMF's concessional lending facility. It was running during the last decade before the crisis at something of the order of $2.5 billion a year. Now, the IMF lent just over $13 billion worth of loans to the 15 countries Stevan had highlighted when showing the depth and variety of the problems being faced by low and middle income countries in 2020. And if you line up next to that, the scale of the new SDR allocation, both of which are put on top of the baseline PRGT lending, you can see that you're getting into the order of magnitude of $20+ billion. And IDA replenishment is a further 80. So it's very significant. Now, the thing that we think is innovative about this is that if the UK were to fund a replenishment of IDA along with other rich countries, which could be the G7, for which the UK holds the presidency, or it could be along with the G20, or indeed in close partnership with the European Union even, then the UK and any other donor that would make that replenishment funded out of a share of their new SDRs would not be under the obligation to put cash into IDA for the next replenishment. That replenishment is scheduled later this calendar year. And if it's anything like the last one, it is going to be of the order of $80 billion. So the IDA replenishment looks like it's going to take place. If it takes place, donor countries would be putting cash into it if they were to find a way through the myriad intricacies of their own institutional arrangements to fund IDA replenishment with a donation that was in turn funded by a share of their new SDRs. That would release ODA cash for their own aid programming. And if you're the UK and you are the president of the G7 and you are struggling to deal with some pretty swinging cuts, especially to your bilateral and humanitarian programs, this is a bit of a get out of jail free card. The UK share, if it was in proportion to the IMF quotas held by the G7, would amount to £5.6 billion out of an $80 billion IDA replenishment. And you could imagine all sorts of different ways in which that could be worked through new programming. You could retrieve cuts in bilateral and humanitarian aid. You could revitalize the fight against climate change when you are hosting COP26. You can include in that step up in tackling the loss of biodiversity, the sort of issues that were highlighted in the Desktop review recently. And you could also step up and take further leadership in funding for COVAX to secure vaccines for countries which are struggling to get hold of them. That's an illustrative allocation, but it shows the opportunities that could be unlocked. I think that what we've got in conclusion is a number of ways to put an innovation on top of what is already a very bold and exceptional issue of SDRs. So next slide, please, Stevan. And I'll just walk through the conclusions of what we have been talking about here. As Steven's illustrated, low-income countries are hard hit, and they cannot do whatever it takes in the same way that rich countries can. The modeling we've done together with Chris Adam at Oxford and the experience so far shows that international finance is vital for recovery, and that domestic reform will be a complement to finance and will strengthen and accelerate recovery. New SDRs can provide finance, especially if redistributed, and lending, rich countries lending to the PRGT at the IMF certainly helps. But SDRs could also fund an accelerated replenishment of IDA, and at some scale. This also has the rather innovative additional benefit of releasing bilateral aid budgets. And examples of what that then offers are increased bilateral support for reform, as well as humanitarian priorities, more finance for COVAX to support the point that the world is only vaccinated when everybody is vaccinated, and further catalyzing the resources that are already pledged to support the global fight against climate change. So we think this is possible. We think it's difficult. We think it requires leadership, and that is among the challenges for any country or group of countries that thought that there was a way of stepping up and leveraging better the new issue of SDRs. And I'll stop there. Thank you very much.
Thank you very much, Mark. You